Have you ever considered tapping into the biggest asset that you do have at your disposal, which of course is your house? Then this video is for you. In today's video, we're going to be talking about the home equity loans, the couple different variations of home equity loans, and how to use them correctly and how to really misappropriate the funds that you get from a home equity loan. Now, home equity loans, of course, are tied to your house. It is a first lien or a second lien position, meaning that if you do not have a primary mortgage on your house, the home equity will take the first lien if it can. And again, we'll go over this just a little bit. But if you do have a primary mortgage or if you do have a first mortgage, the home equity product will take the second lien position for your home, meaning that if you default on the house, if you're not paying your bills, the original or the first mortgage does get paid first. If there is anything left, that second mortgage will get paid, which is the reason why they limit the home equities with the ability to get their money back. Now, typical home equity will be 5 years up to 20 years, even though there are some lenders, depending on the balance, will lend up to 30 years on a home equity product. With the home equity product, you cannot lend or you cannot borrow up to 100% of the value of your home. So this is the way that the mortgage companies and the financial institutions put a little bit of a cushion. Most of them will only do 80% of the value of your home that you can actually borrow. Well, there is some of them at a much higher rate that will do 90%. And if you're really shopping out there, you possibly could find one that will do 100% of the home equity or the financing within there. Now, within home equity products themselves, there are fixed rates, there are variable rates or home equity lines of credit, and there is also interest only home equity line of credit. And again, we're going to break those down a little bit because you have to know the in and outs of those guys and really what you're getting into. Now, when it comes to the first one, or when it comes to how you could actually borrow this money, to do a very simple kind of step-by-step equation, it is the home value, the percentage that you owe or what they're going to let you to borrow. So like I said, for this instance, we're just going to use a home value of, let's say, $100,000. The percentage the lender will let you borrow. So let's say they will only let you borrow up to 80% of your home's value. That means the maximum that you can borrow is that $80,000, barring you not having a first mortgage on the property. Now, the other way that you can look at this, guys, is the home value by the percentage that they'll let you borrow. So again, using that $100,000 home value, 80% is what they'll let you borrow. Now, at that point, if you do have a mortgage from that $80,000 of equity that you do have that you've built in your home, you're going to have to minus out the balance of the first mortgage. So let's say in this scenario that you do owe $60,000 on that first mortgage. That means your equity will be capped at $20,000 for the value of the home based on what you can borrow. Now, what is a home equity used for? This, again, is one of the big places, guys, where you can either use it for something good or you can use it for something really not so good. So the correct way or the real positive way to use a home equity loan is when you're using it for home renovations or home improvements. So what you're doing is you're taking the asset, which of course is the home, you are putting more money into your asset in hopes in the future that you're going to get more money out of the asset. This is going to be the beneficial reason to use a home equity loan. Now, what we see a majority of people doing nowadays is they are taking the equity off their house and they are using it for debt consolidation, which in my opinion is really turning that asset of the home into a very large liability. Because now, due to your credit card debt, because of your poor budgeting habits, because of your poor spending habits, you put your house in jeopardy by doing a home equity loan and consolidating the debt, which again, I really do not advise doing the home equity loans for debt consolidation. I know it saves money. I know it saves on monthly payments, but overall, like I said, you're putting your home at risk by consolidating your credit card debt. Home equities should be used in their entirety for home improvements that you're actually going to get a better rate of return on or a better asset that you're going to have worth more value. Now, home equity loan rates as of 2023, guys, they were at about 3.5% looking at 2022, looking a year and a half ago. Home equity rates are 8.5% plus right now. So when you think of that, guys, it is an astronomical payment for a majority of people, because even if you, let's say you refinance in the last couple of years to your, 2.5%, 3.5%, 4% on your primary mortgage, if you're adding on an 8.5%, 9.5%, 10%, 12% home equity on there, your payment is going to be astronomical depending on the balance you have on there, which is going to be very, very hard to really swing the payment, even if you're doing consolidations. Now, to get some of those best home equity rates that we have, number one is a 720 or a 740 or better credit score to get the absolute lowest rate. So if you do have, B, C tier credit, if you're a 650, 680, chances are on a home equity product, you are going to get a much higher rate just based on the credit score. Now, home equity loan requirements, these fall pretty similar to what we see with mortgages. Home equity has to say, 10 to 20% of the value. Credit score has to be 620 or higher. And then, of course, the debt to income ratios, meaning the amount that you actually have in income in conjunction or in relationship to your debt, has to be 50% or less, depending on the product. They can go up to 50%, some of them 45%, some of them say 43 or lower. Again, you have to check with your lender to know exactly if you can qualify and what the qualifications for those products are going to be. Now, some of the pros for this, guys, fixed rate, depending again on the product, could make your budget a lot more easier, especially to pay for larger home improvement projects. If you're looking to redo a kitchen and it's, 40, 50, $60,000 that you need, that is a really big price tag to save that amount of money. Home equities can make it a little bit easier, but then again, you have to think big picture, guys. Let's say, for instance, you're doing a $50,000 home equity, you're doing it over 10 years. Now your $50,000 kitchen could cost $65,000, $70,000 when you're finally done after 10 years of paying for that kitchen, which again is kind of incredible. But in conjunction, guys, home equity products, because they are associated with that asset, you are going to get a much lower rate. You're going to get a much lower rate than personal loans, absolutely a much lower rate than credit cards. But you do have to remember, this is a payment that you're going to have to cover. If the mortgage rates are low, don't refinance primary mortgage to take cash out. Again, it is a way that a lot of people are doing debt consolidations. But with that being said, guys, it is very, very expensive because you have closing costs on one side of it. And you also have to be careful with home equities because a lot of people do charge money, application fees, early termination fees. A lot of things can be really tied into those. Now, of course, some of the cons with this, guys, is when you look at a home equity product, you're tying it to your house, which is one of the absolute biggest things. If for any reason, if it's a job loss, if it's a death in the family, if you cannot pay the home equity, they have a lien on your house. They have the right to foreclose on your house. Now, let's talk about home equities, guys, in the different variations or the versions that we see. So number one is a fixed term, fixed rate. So what this means, again, going back to our scenario, if you're looking to borrow, let's say $50,000, it is a fixed rate, meaning that you're going to pay that 8.5% over a fixed term. So it could be over 10 years. So that mathematically, you can break it out to do the equation where if you're borrowing $50,000 at an 8.5% rate over 10 years, you have X amount of payments and it is paid off, guys, in that 10-year period. Now, in addition, there are home equity line of credits or HELOCs. These vary a little bit because this includes principal and interest, and it is an LOC or HELOC line of credit. So this means that it gives you the flexibility. It's like almost like a giant credit card against your home with a much lower rate. So again, if that HELOC is 8.5%, you can borrow what you need. So if you do a home equity line of credit for that $50,000, you can borrow what you need and you only pay for what you're borrowing. So if I have that $50,000 line and I only need $10,000, I only pay interest on the $10,000 that I borrow. Now, with a home equity line of credit, you do pay principal and you pay interest together when you are making those home equity line of credit payments. Now, the third option of this is the interest-only home equity line of credit. So again, think of it as a really big credit card that you do have held against your house. But with the interest-only home equity, you are only responsible for the interest-only portion of that payment. So how that breaks down, again, our scenario, you're borrowing $50,000, you're borrowing it over that 10-year period. Most of the line of credits are open for 10 years. But when you borrow that $50,000, you are only responsible, your only obligation is to the interest that is accumulated on that line of credit. So if you take $50,000 off, you're paying the interest only every single month. At 10 years, when that line is expiring, guess what? You still owe $50,000 on that interest-only line of credit because the entire 10 years that you've been making those minimum payments, 100% of that minimum payment went to interest. You have never touched the principal on your home, which means after 10 years, again, you still owe $50,000 on that home. Now, guys, home equity line of credits, again, they can be used just like credit cards, just like loans. They can really be used as a tool for improving your home, which is the primary purpose of the home equities, not used as the debt consolidation, not used as a crutch to try to clean up all of your credit card debt or all of your personal debt from not budgeting correctly and not properly, doing your income in relationship to your expenses and figuring it out, guys. But let me know what you guys think about the home equity products and if you're using any of them yourself. If you like the content that I'm providing, go ahead and subscribe to the channel, guys. Let me know in the comments what you guys think. And as always, thank you guys for watching.